us for this live webinar on how to plan for a successful pharmacy sale. We'll give a couple of minutes for any latecomers just to log in. And in the meantime, let me just explain. Today's webinar is going to focus around a hypothetical case study. And we've uploaded a background information sheet for you to read through. You'll find this in the download section in the menu panel on the right-hand side of your screens. And it'd be a good idea if you just have a glance through this case study now, just to familiarise yourself before we get started. The next few minutes is also a good opportunity to get yourself a drink and a snack if you want to, as we do expect the webinar to last over 90 minutes. Right, okay, so I think we'll get started. Thanks again to all of you for listening in this evening. I'm Scott Hayton from Hutchings Consultants, and I'm joined this evening by Paul Savuto from DGS Financial Planning, Tim Jenkins from Charles Russell Speech Lease, and Artif Butt from Hutchings Accountants. Our aim tonight between the four of us is to demonstrate some of the pitfalls in the sale process, and also the importance of having good advisors behind you that can work together as a team to improve the value of your business, also reduce your tax bill, and generally provide you with a more comfortable retirement. So just a quick overview of our case study before we jump in. The Patels have owned and operated Lucky Star Pharmacy since 1993 and have been in touch with Paul Savuto at DGS in respect to their finances since they acquired the business. In 2016, they approached Hutchings and Charles Russell Speech Lease to inquire about valuation and the process of selling, even though they planned to hold on to the business for another few years thereafter. This is where we pick things up now, as collectively Paul, Tim, myself and Artif advise the Patels on some key points around preparing for sale and retirement, focusing on how they can make the most of this, the most valuable asset, and generate a larger retirement pot. Paul's going to kick things off for us, starting with how he assisted the Patels in their early years of ownership. Before I hand over, I'm sure there's going to be some questions from listeners as we progress. Now, in the panel on the right-hand side of your screen, along with the downloads for this evening, you'll find a dialog box for submitting your questions. We have set some time aside at the end of the webinar to answer those, but any that we don't get to, we will, of course, respond to personally over the course of the next day. So let's kick things off, and here's Paul to start us.
Good evening. My name is Paul Savuto. I work for DGS Financial Advisors. I'm a chartered financial planner. And most importantly, when you're looking for financial advice, you should certainly source an independent firm of financial advisors. That screen here just shows a bit about my firm, and the main thing is we've been established for over 20 years, and our primary aim is to look after our clients to the best of our ability. So what do financial advisors do? Well, we provide advice regarding your financial matters, and most importantly, we provide you with ongoing reviews to make sure you're on track to achieve your goals. Our typical areas of advice is wealth creation, preservation, investing your money in ISAs, pension planning, both at retirement and obviously building up to retirement. What do you do when you get to retirement? Obviously looking at all the different tax planning opportunities there are, and even down to the basics of providing you with a mortgage, family protection, and helping you with wills and powers of attorney. So, 25 years ago, when I first met the Patels, I said to them, if you do nothing and save nothing, then at best we will have to rely on the state pension, which currently is £164 per week, providing you work for 35 years. So no savings, then all you get is £164 a week, which for some people may or may not be enough. Obviously, there are lots of issues along the way, and obviously the main ones are people are living longer. Inflation, so the cost of living is going up. So each year, the price of bread, beer, milk, petrol is costing more. And obviously, personal taxation, this changes all the time. So different rates of tax, depending on how much you earn, different allowances and different rules. So there's always issues along the way. So even though you think there may not be issues now, as years go by, there are always things to consider. So what did I discuss with the Patels and what did we do to start with? So 25 years ago, their life was fairly simple, but the main and primary thing we need to look at when you're young is protection. And what I mean by that is what happens if you die? What happens if you're sick? How do you pay off the mortgage? How do you provide for your children? How do you receive an income if you can't work? So for the basics, we just set up some income protection, some life cover to pay off the mortgage and provide a little nest egg should either of them die. We also talked about pensions and ISAs, and obviously at the time their excess income was very little. So the main thing I said to them, let's just start off with a £50 a month plan in both their ISAs and pensions, and when you have more money, we'll review this and hopefully get the company to pay in more as we go along. We also made sure their wills are intact to make sure that their wishes were fully respected. So their money went to where they wanted to, and as and when they got children, we made sure there's guardianship clauses. And of course, we helped set up their mortgages for them as they took their first step onto the ladder. The most important thing was obviously, this was 25 years ago, and as I said earlier, we provide an ongoing review service. So every year we went back to see Raj and Simran to talk about their finances, their current situation, how their life has changed, and basically updated their plans as we went along and their circumstances. So maybe took out some more life cover. Obviously they moved house a few times, and we increased their pension and their ISA savings up to the amount they could afford per month. So that's a very, very brief overview of what we did. And later on in this, you'll see what they ended up with when they've come to retire. I'm now going to hand over to Atif to take you through.
Thanks, Paul, and hi, everyone. My name's Atif Butt, and I'm the Senior Accountant at Hutchings Accountants. We've been specialising in pharmacy sales for over 30 years, and I'm here to talk a little bit about what we've learned along the way. We're going to start off with a question. When do you think is the best time to start preparing for your pharmacy sale? Well, believe it or not, the right answer is today. The truth is, it's never too early to start getting ready, even if you don't plan to sell for many years. Being properly prepared can make a huge difference in not only the price you eventually get, but also how much you're left with to maintain your lifestyle over the course of your retirement. As we've heard from Scott, Raj and Simran Patel approached Hutchings in August 2016 to obtain a free valuation of the business so that they'd have a good understanding of what it might be worth if they were to sell. Following this initial conversation, I was able to introduce myself and offer to provide them with a free review of their accounts and tax position. Once you've decided you want to sell your pharmacy, re-review your position to recommend the most tax-efficient way to proceed. Getting the structure of your sale right can have huge tax implications that could make a difference of hundreds of thousands of pounds to your tax bill. So it's important to look at this as early as possible, as it sometimes can involve making changes to the company or seeking clearances from HMRC. The Patel's pharmacy was trading through a limited company, Lucky Star Limited, and the first thing we looked at was whether the Patels should sell the business through a share sale or an asset sale. Here's Tim Jenkins from CRS to talk about both options. Over to you, Tim.
Thanks, Artif. Good evening, everyone. So I'm a partner with Charles Russell Speechlys. We're dedicated pharmacy lawyers, and I lead the team that looks after our pharmacy clients with a particular focus on retirement sales. So as Artif has mentioned, Mr. and Mrs. Patel run their pharmacy through Lucky Star Limited as a company. And in the context of how they sell the business, they therefore do have a choice in the sense that they can either look to sell the shares of the company to the purchaser, or alternatively, they can retain the company and have the company sell the assets of the business to the purchaser. So I thought we'd just have a quick look at the key differences between those two approaches in a legal sense. So looking firstly at asset sale, in this situation, there is a change to the operator of the business in the sense that the company would be selling the assets of the business and its day-to-day contracts, including the NHS pharmacy contract, to the purchaser. That does mean that NHS England's consent would be required for a change of ownership of the NHS pharmacy contract. Now, that process can take anything up to 3 months to obtain. It's a little bit quicker in Wales. I've mentioned NHS England. The equivalent in Wales is the Local Health Board. So that's worth keeping in mind in terms of just planning ahead. A couple of other practical points. Where there is a change to the operator of the business, the employees in the business will generally have a right to transfer their employment to the new employer, the purchaser, and there is a legal requirement to go through a process of informing and consulting with the staff a reasonable time before the sale is completed. So that also needs to be factored in. You may also find that with an asset sale, there are other third-party consents required. So in our scenario, Lucky Star Pharmacy operates the pharmacy from leasehold premises. Most leases nowadays have a requirement that on transferring the lease along with the other business assets to the purchaser when completing the sale, that is something that would require the landlord's consent by way of a written document. So again, that is worth factoring in terms of planning ahead. I mentioned that there is less buyer risk in connection with buying the assets of a business. I mean that in the sense that, as a general rule, once the buyer takes over the business, they're only responsible for the operation of that business and the liabilities of the business from the point at which they take it over. They're not generally responsible for what might have taken place in the past in relation to that business. There are more logistics, therefore, involved with an asset sale than with a share sale, and the process may take a little bit longer than a share sale, given that one has to interact with certain third parties. So contrasting that with the share sale option, which would involve Mr. and Mrs. Patel selling the shares of Lucky Star Pharmacy to the purchaser. In that situation, there is a change of ownership of the company, but not a change in the person operating the business. That will remain the company, which means that some of the logistical and other points that I've just mentioned will probably not apply. So generally, there won't be a need to obtain third-party consents. NHS consent, provided the NHS contract is held within the company, wouldn't be needed. Landlord consent, which I've mentioned in relation to the premises lease, will probably not be needed. It is always worth checking the terms of your lease, because certain types of lease do occasionally still have a provision requiring landlord consent, even if it's a change in the ownership of the company as the tenant. Most notably, you tend to find those in health centre pharmacy leases. The requirement to inform and consult with staff wouldn't apply on a share sale. That doesn't mean, of course, to say that retiring vendors will not be letting the staff know of their plans ahead of time, but it does mean that there isn't a formal process within which that dialogue needs to take place. So there is less involved logistically, and potentially the completion of the sale could be a little bit more quick. There is more buyer risk in the sense that when acquiring the company, of course, the buyer does inherit the history of the company, unlike with an asset purchase. I should say that that fact doesn't, in my experience, tend to put off buyers from acquiring businesses through the share sale route. It's quite a common arrangement nowadays, and most buyers are comfortable with it. What it means in practical terms is that the buyer has a little bit more due diligence to go through in terms of questions about the business and its finances before the completion takes place. And I'll pass you back to Artif.
Thank you very much, Tim. Now, to decide on the right structure for the sale from a tax point of view, we worked out what the Patel's estimated tax bill would be from each option, as there's a considerable difference in the tax treatment. A share sale means they'd be taxed personally on the gain and pay capital gains tax, whereas an asset sale would mean the company selling the business and paying corporation tax, and the Patels then being subject to a further personal tax charge when they took out the profits. When we ran the numbers, we found that an asset sale would cost them an extra £200,000 in tax compared to a share sale, and so we recommended a share sale as the most tax efficient option. Our review of the accounts for the company also picked up a number of other potential issues. The layout of the accounts, although technically correct, didn't showcase the business as well as it could have. The cost of sales figure included some staff and locum costs, which resulted in a lower gross profit margin, making the business look less attractive to potential buyers. We also noticed the pharmacy staff costs had increased by 3% from the previous year and were above average for pharmacies of a similar size and location. Also, over the years, the pharmacy had been very successful and made significant profits. And as these profits were regularly more than the salary and dividends taken, the company had built up significant cash reserves. Instead of leaving the money just sitting there, Mr. Patel used some of it to purchase a flat as an investment owned by the company. Finally, some years ago, the Patels transferred 20% of their shares in the company to their youngest child, Rahul. At the time, they thought he might qualify as a pharmacist and eventually take over the business. But in the end, he ended up developing an interest in finance and studied this at university in order to become a stockbroker. Now, these last 2 points are very important as they could potentially restrict the availability of entrepreneurs relief or ER on all the sale proceeds. Entrepreneurs relief is a relief that can apply when someone sells part or all of their business and means they only need to pay tax at a rate of 10% on the gain as long as certain conditions are met. Each individual has a lifetime limit of £10 million worth of gains that can qualify. In a share sale, the qualifying conditions are that you need to hold at least 5% of the shares and be either an employee or officer of the company, which must be a trading company. The rule used to be that these conditions had to be met for at least 12 months before the disposal, but in the last budget, the Chancellor made a surprise announcement to extend this period to 24 months. So, without ER, if the Patels were to sell their business for £1 million, they would be liable to capital gains tax at 20%, which is £200,000. But if they qualified for ER, this would be reduced to 10%, meaning they'd only need to pay £100,000, which is a huge tax saving. However, there are circumstances where you may not qualify for ER. For example, when you're trading through a limited company which also owns a significant amount of investment assets such as shares or property, or which has an excessively high level of cash in it at the point of sale. It's very important to identify any problems as early as possible so you can take the necessary steps to remedy them. And with the recent increase in the qualifying period from 12 to 24 months, this now needs to be looked at even earlier. In this case, we were able to advise the Patels on the actions they would need to take to make sure they would qualify for ER when they sold. This involved making changes to the shareholdings and extracting the investment property from the company, which Tim will be talking about in a bit more detail later on. The Patels said to us that ideally they would like to sell the business in between 2 to 3 years, So we recommended they take advantage of our roadmap to sale service, which is aimed at pharmacy owners who'd like to increase the business's value before they sell. They agreed to engage us as the accountants for the business, and we got to work. Using the initial valuation prepared by Scott, we identified the key performance indicators affecting the value and looked at how these could be improved. We also looked at the issues picked up in our review of the accounts and tax position and worked out the steps necessary to resolve them to ensure the Patels would get the most favourable tax treatment when the time comes. Finally, we mapped out a list of prioritised targets we wanted the business to achieve and a timeline over which we wanted to achieve them. In this case, we focused on reducing stock holding and wastage, improving the business gross profit margin, reducing the staff costs, and making sure the sale would qualify for ER. At this stage, it's also worth looking at how you can start preparing for some of the legal aspects of the sale. So I'll hand over to Tim to tell us more about this.
Many thanks, Atif. So, preparing for sale, I thought I'd start with just a few thoughts in a property context. First thing to mention is that whether you're selling a business that operates from freehold premises or leasehold premises, and it may be that part of the sale arrangement is that if you own the freehold, you're going to grant to the buyer a new lease, perhaps, for the pharmacy. There are some important documents that have to be provided as part of the property transaction, and these are required by law. A number of them pharmacy owners are required to hold day to day, irrespective of whether you're selling, just in the context of being an employer. But I've given a couple of examples here. So an EPC, or Energy Performance Certificate, for the building is now a legal requirement. PAT certificates, which are the electrical safety certificates. And there are others, asbestos management reports and so forth. So it's worth giving some thought to what documents and reports you're going to need and getting those lined up and in place in good time. In our scenario, the pharmacy operates from leasehold premises, and there are some particular points to consider when dealing with leases. One of the things that we offer is a free pre-marketing phase lease audit, essentially a headline review of your lease, just to identify anything that may not pass muster, as it were, with a buyer's lawyers, recognising that most buyers nowadays do purchase with the assistance of bank funding, and therefore the bank is likely to have some fairly standard requirements for what they want to see in security terms on the terms of the lease. Some key points to consider would be the length of your lease and how long it's got left to run, whether it's a renewable lease when the lease term expires. Is the lease held in the correct name? We see it quite often that sometimes a business was originally set up with a sole trader pharmacist running it, and for tax reasons it got converted into a limited company a few years ago. Did the lease get put into the company's name? If not, that's something that would need to be corrected before the lease can be sold on. And giving some thought to what the lease says in terms of landlord consent requirements. I've mentioned one of those already in the context of an asset sale and requiring landlord consent for that. But there are also points that would potentially be relevant on a share sale. For example, whether the lease requires landlord consent if the lease is going to be used as security for a bank lending to a purchaser. So those are all points that would be useful to identify and plan ahead for at an early stage. Leaving aside property points for a moment and focusing on some of the more commercial items that would typically be requested from a purchaser's solicitor as part of the legal due diligence process involved in the sale, there are some typical items that will always need to be provided and which it's worth making sure you are lining up ahead of time. For example, employment contracts with your staff, the employment handbook, employment policies, have you got all of those in place? Pension documents. Most pharmacies nowadays have to comply with the auto-enrollment workplace pension scheme of arrangement, making sure that you can demonstrate that your documents are in place, your declaration of compliance, for example, on the workplace pension scheme. There will normally be some fairly key commercial contracts that the business is a party to. For example, an agreement with the provider of your IT system, which might be either owned or on hire finance terms, but there will normally be a software support and maintenance arrangement sitting behind that. The insurances of the business. And giving some thought at the same time to whether any renewal dates are coming round on some of the key commercial contracts. If there's a renewal date that's likely to come up right in the middle of the point at which we're looking to market the pharmacy for sale, it's worth giving some thought to whether those contracts could be renewed in anticipation. Business records, always worth making sure that you've got a full and accurate up-to-date set of business records. That would include employment records, pension records, VAT records, and the various pharmacy records that regulations require to be kept. It's also worth giving some thought if, for example, your pharmacy does operate through a limited company, as is the case here, to whether the directors have had to give any personal guarantees for the company's commitments. Classic examples being if the company has some secured finance from its bank, the directors may have been asked to give personal guarantees to the bank to back up the repayment obligations there. If you've got particular finance leases, it may be that perhaps the pharmacy has a robot, the directors may have given personal guarantees in relation to those commitments. And of course, it's possible that the directors may have been asked for a personal guarantee by the landlord if the business trades from leasehold premises. And it's worth identifying those at an early stage, and it's a point that I will come back to a little bit later in the presentation. And finally, but by no means least, key registrations. In a pharmacy context, the key registrations that would need to be checked and make sure they're in order would be the GPHC premises registration, which should be in the name of the operator of the pharmacy, and the NHS pharmacy contract, which again should be in the name of the operator of the pharmacy. Now, Atif has mentioned that in our situation, Mr. and Mrs. Patel decided to purchase an investment property a couple of years ago, which they acquired through Lucky Star Limited, so as to use some of the surplus cash within the company at that point. In our situation, their view is that they don't wish to include the investment in the sale, but they do want to proceed with the sale for tax reasons, as Atif has mentioned, as a share sale. And therefore, we needed to give some thought to how that investment property could be extracted from the company ahead of completion. And it is worth giving some thought to how that will be achieved in plenty of time ahead of completion, as there are a number of ways in which it can be done. Some may take more time than others, and some may be tax driven, but it's worth coming up with an action plan at an early point. I won't mention all of the options, as there are a great number, but the three most common, the first would be extracting the property into the director's pension scheme. We see this from time to time, and it can have some tax efficiencies. I won't dwell on this option too heavily, as there are some quite complicated pension rules that wrap around it, and I'm sure that's something that Paul would be very happy to advise on. Suffice to say that the main consideration whenever transferring capital value into a pension is that it is to an extent locked up, in the sense that it's quite difficult to re-access that value ahead of retirement age. So it's an option, but it's not for everyone. Two perhaps more common options would be to transfer the property out of the company to the shareholders at what's called book value as a dividend to shareholders, or alternatively transfer the property to the shareholders at market value as a form of arm's length sale. So looking at those two options in a little more detail, in our scenario, when looking at this, the book value of the investment property in the accounts of Lucky Star Pharmacy was £144,000. The book value is the value of the asset in the accounts having applied depreciation rates to the original purchase price, which is why book value may often be less than market value. Provided that Lucky Star Pharmacy has sufficient distributable profits in an accounting sense to match that £144,000 worth of value, Lucky Star Pharmacy could declare a dividend to Mr. and Mrs. Patel of £144,000 and satisfy that by transferring the property to them. And in that situation, Mr. and Mrs. Patel end up where they want to be. They will own the property. It will have been extracted from the company. They won't be required to pay anything for it, but there is a major downside to this option in the sense that they would be liable to pay dividend income tax as the shareholders, and assuming that they're higher rate taxpayers, that would mean quite a hefty £65,000 tax bill. So perhaps not the most tax efficient option to be looking at. So we therefore looked at the third option, which is a transfer at market value. So the market value of the investment property in our situation was £220,000. And we came up with a solution, which would be that the company sold the investment property to Mr. and Mrs. Patel as the shareholders for that value, which again had the same result in terms of the property becoming owned by the shareholders and having been extracted from the company. The sale was effected a month or so before the sale of the company was to go through. And at the point of transferring the property, the value was left outstanding as a loan made by the company to the shareholders. On completing the sale of the shares in the company, Mr. and Mrs. Patel were able to use the sale proceeds to repay that loan. And using an accounting methodology in the sale documents, which is something I will come back to later, it meant that the loan repayment found its way back into Mr. and Mrs. Patel's hands ultimately as part of the final share price, which meant that it had a neutral impact in terms of the overall sale proceeds received by Mr. and Mrs. Patel. They weren't short by £220,000 at the end of the process. This did mean that there was a lower tax charge for Mr. and Mrs. Patel to fund. Firstly, there was a personal tax charge, capital gains tax, at 10% on the basis of qualifying for entrepreneurs relief on the value of the property, so £22,000 in our scenario, and there was a small amount of corporation tax for the company to pay of about £8,000, but overall a £35,000 tax saving when compared to the dividend option. And I'll pass you back to Atif, who will develop the story further.
Thank you, Tim. Some really useful things to think about there. So, working with the Patels over the next 2 years as part of our Roadmap to Sales service, we used customised management reports to analyse and monitor the business performance each quarter and ensure that Raj and Simran were on track to meet their targets for improvement. During this time, we also used the management reports to compare Lucky Star Pharmacy to similar pharmacies in a process called benchmarking. Now, benchmarking can be very useful as it helps us see how the business is performing compared to others in the market and can provide useful insights about things we are getting wrong or right. These management reports also help us look at how the potential market value of the business is changing as time progresses based on the most recent performance, so we can verify whether the numbers are moving in the right direction for the Patels. Twice a year, we reviewed the results and re-evaluated our plan where necessary. That way, we could also factor in any changes in circumstances. For example, towards the end of the first year in June 2017, Raj and Simran decided they'd like to bring forward their decision and sell in the next 12 months, as their daughter Richter was planning to get married. So we re-looked at our targets and timeline and amended them accordingly. The aim of this process is to increase the value of the pharmacy as much as possible before it's put on the market. It's important to remember that every £100 spent on getting the right professional advice and input can increase the profitability of your business by thousands of pounds, which in turn can increase the value of your pharmacy by tens of thousands. Now I'm going to hand over to Scott to tell us a bit about the marketing process.
Thanks very much, Artif. So, Richter, the Patel's eldest daughter, getting married, this is a good example of how circumstances can change quickly and why it pays to plan ahead. The first thing I need to do for Raj and Simran is to look at their latest figures and carry out an updated valuation to see how things have changed during the last year. Now, there's a fair bit of information that I'll need for the valuation, and in the downloads you can find a summary of this, but here's a quick rundown for us. We need copies of the latest accounts, the last 12 months NHS statements, 12 months VAT returns, premises lease with confirmation of the current rent and rates payable, and a schedule of all of the staff at the shop detailing their role, hours per week, and rate of pay. We'd also gain additional information about the specific trade makeup of the business, its circumstances, and general potential through discussion with the client. And this gives us a broad oversight of the business on which to base our valuation. Now, without all of this, it's going to be very difficult to provide Raj and Simran with an accurate valuation, and we'd only really be able to guess at it, which is not much use to anyone really. We can talk about pence and pound valuations, which I'm sure everyone is familiar with. It's basically looking at previous sales and adopting an average number of pence paid for each pound of turnover. Now, the difficulty with pence and pound is that it does ignore all of the unique factors of the pharmacy, such as its location, rent and rates, staff salaries, and profitability. All of these things are going to vary. So because of that, we can never rely on pence and the pound alone as a methodology, and it can only be used as a guidance tool when the EBITDA, or bottom line profit multiplier method, doesn't reflect quite what our gut is telling us. I've tried to demonstrate with this slide here, there's a lot of factors that affect pharmacy value, and I wanted to spend a little time talking through some of the key ones with you here today. So firstly, we'll look at high levels of counter sales, private scripts, nursing home, or dotted items. And these can sometimes detract from a pharmacy's value. It's all to do with risk and security of these incomes. If these incomes make up more than about 10% of turnover or 25% for OTC, it can be seen negatively by the market. The higher the NHS proportion, traditionally, the better things are going to be viewed. There's also a greater perceived risk with scripts that are written weekly by GPs, and there's been quite a well-publicised push away from weekly to longer prescribing periods recently, which, if it happened in our circumstances, would directly affect the pharmacy's turnover and monthly items. Premises costs. So these are likely to be one of your biggest bills after wages. Lower rent and rates means for higher profits, and that also allows for potential for higher goodwill value. In addition, if the freehold is available to buy with the pharmacy, then it can make the opportunity more desirable overall, and in a competitive bidding environment, could mean that you see a higher price paid for the business. Surgery moves. Whether these are planned or rumoured, these will make buyers worry about the continuity of the business. We continue to see a fair few health hub redevelopments popping up, but in England particularly, we're also seeing a lot of single doctor practices closing their doors and having their patient lists merged by the CCG. And that means it's uncertain who may secure those scripts going forwards. High wage costs or overstaffing. Now, this is an issue that we actually see quite often, being prevalent in retirement sales as owners inevitably start to slow down. Now, it probably goes without saying, but no one actually wants the job of making people redundant, and that's going to include your buyer. It's complicated and it can be a costly legal process to deal with. It's certainly a hassle, and there can also be backlash from the remaining staff. Location. This also affects price. So large cities away from coastal areas do tend to generate higher prices because there are higher concentrations of buyers that are either living or looking there. As well as those regional variations, there's also national level variations, with large premiums being paid for Scottish and Welsh city pharmacies when compared broadly with the English prices. Now, this is partly because there are less pharmacies in Scotland and Wales and therefore less supply for market, but also because the funding outlook is more positive than in England. Business potential. So generally speaking, it is best to leave something on the table for the incoming owner to develop and make their stamp on. If you've maxed out every aspect of your business and left nothing for the buyer to grow, you could actually see less interest and a lower price achieved as a result. And the final point I'll mention here is the presentation of your financial accounts. You need an accountant who's experienced in pharmacy, who can present your figures clearly and demonstrate the profitability of the business in its best light. Artists already mentioned about having your locum costs in the correct place, and this also goes for items like wholesaler rebates too. Otherwise, your gross profit margin as a percentage can appear lower than it actually is. In the years running up to your sale, you should try and keep any personal expenses to a minimum. And overall, I think if you've got decent accounts, it tends to inspire confidence from buyers and lenders, which in itself can help to generate more offers, but also less questions and stress for you during the sale process. Any issues you do identify during the initial valuation should, where possible, be resolved before you approach the market. Your aim should always be to try and build trust with potential buyers. We definitely don't want to erode it. So if there are serious issues, such as surgery moves or similar, you should always be upfront with buyers, as these matters inevitably do come out in the due diligence process. If you lose your buyer's trust, believe me, it will be very difficult to regain it. So when I received the phone call from Raj telling me that they'd like to sell sooner rather than later, I know this artist has already helped improve matters. He mentioned earlier that he's tidied up the structure of the account, so we can take a quick look at those here. On the left are the old accountant's figures, and on the right are the figures incorporating artist changes. These now make it far easier for buyers and lenders to assess the business accurately. You can see the difference in margin demonstrated here in red, and this is achieved through moving the locums to expenses rather than the cost of sales. This, together with the targeted work that Raj and Simran have been doing in the pharmacy, the numbers for 2017 look a whole lot better too. You can see we've moved from a gross profit margin of 31.3% in 2016 to 33.1% in 2017. And also the profit before tax is up by £50,000. And that's in part due to Patel's effort to reduce their wage costs. In any pharmacy valuation, gross profit annual buying is the single biggest factor that determines the price you'll receive. And a relatively small improvement here can make a very big difference to the price that you'll walk away with. And we'll look at this point in some more detail shortly. When I carried out my first Goodwill valuation of Lucky Star Pharmacy in 2016, Raj and Simran had a total salary bill, including their pharmacist and NIC costs, it was equivalent to 16.2% of their turnover, and that was based on their original March 16 accounts. They've now reduced this to 14.6% in the 17 figures. Now, as a rough guide to staffing costs in the current climate, we'd hope to see a figure somewhere close to about 14% of turnover, and this would represent pretty tight cost controls for a pharmacy similar in trade to Lucky Star. If turnover was lower, something like about 750,000, then we'd expect to see the relative percentage rate increase because there is a minimum staffing level that you can operate any pharmacy business at. In the same vein, if Lucky Star was carrying out a lot of labour-intensive work, such as nursing homes or high-volume dossier boxes, then we'd expect to see the percentage rate to be higher still. So here's a quick recap then of the improvements Raj and Simran have made since my first contact with them. Obviously, we've got the accounts looking a lot clearer, more appealing, and this should help boost the confidence that we're seeing from the market and lenders. Gross profit, they've added £21,000 in profit here, and in the expenses through the wage reductions, they've saved close to £20,000 here. If we now look at my valuation workings, you'll see how the two valuations compare. So my first valuation from 2016 based on the rolled accounts is on the left versus my latest valuation using the improved figure for 2017 on the right. In the expenses for 2017, you can see that Raj has shopped around and he's managed to shave about £1,000 in total from his insurance and energy bills. Now that may not sound like a huge amount, but any saving that you do make to expenses is multiplied several times by the market to arrive at an offer. Now, our recent stats at Hutchings show that the average profit multiplier achieved in London is around 9 times. So Raj and Simran have the potential here to turn that £1,000 saving on utilities into £9,000, which would be a pretty good result. Coming back to the point on gross profit margin though, using the figures here, you can see why your buying and stock control is so important. As a simple example, on a £1 million turnover pharmacy, every 1% increase in gross profit margin adds £10,000 to your bottom line profit. If you apply a reasonable multiplier of say 8 times to that, it becomes £80,000 in goodwill. It's vitally important then not to lose enthusiasm and become complacent with your buying, because similarly, every 1% margin that you lose has the potential to reduce your price by a similar amount. Now, before I arrive at a true EBITDA figure, which we can use for valuation, there are adjustments that are needed to the figures as we see them in the year-end accounts. Now, you can see in both years' valuations here, I've added back the depreciation, as this is not a real cost for buyers. I also added back directors' remuneration, since I've already accounted for a full-time pharmacist salary and additional locum cover at the top of my expenses. Part of the director's remuneration was the salary that was paid to the Patel's son Rahul for his time during holiday period. So this can be wholly discounted, along with the rental income from the property, from the Patel's investment property, as this is now being removed from the company. If there were personal costs in these expenses, such as directors' vehicles or one-off property repairs, then I'd also look to remove those. But Audit has worked with Raj and Simran to get these out of the company, including personal cars. So we're left with true expenses that reflect just the pharmacy trade. The EBITDA figure for 2017 is seen here at £172,622. Compare that with my previous valuation, the best that I could get this to was £145,405. And even that was after having knocked £10,000 off of the Patel's staff costs at that time. So the difference in profit for 2017 based on these bottom lines adds up to about £200,000 in additional business value. I'd applied a multiplier of 8 times, and that was based on the location and market comparables, and that suggested a value in the region of 1.4 million. I then considered what that price represented, looking at it from a pence in the pound perspective, because despite not having much grounding, the market can't quite seem to break the habit, and pence in the pound does also tend to act as a bit of a cap and floor for prices. So 1.4 million represents 115 pence in the pound, and considering all other factors that I need to, this for me confirmed it was a good place to start the marketing for Raj and Simran. Now, we already discussed the average multiplier for London has been 9 times recently, so you may ask why I've not used that. Well, we have to be careful in the marketing stage not to scare buyers off. Getting them to digest the information fully, piquing their interest and generating viewings is essential if we want to demonstrate the full potential of the business and encourage that party to make an offer. If you pitch the price too high, particularly in today's market where there are more pharmacies available, more choice, and arguably more risk for buyers than we've seen in recent years, it could mean that you struggle to generate a competitive bidding environment. And it's this competition between buyers and having multiple parties to negotiate with that allows us to achieve premium prices for sellers. That's in theory how you might hit a 9 times multiplier. And at the same time, it puts us in a much stronger negotiating position that can help secure better terms of deal for our clients. Things such as a higher deposit, staff bonuses, or shorter timescales to completion. So where does Raj and Simran's sale go from here? Well, let's just take a step back and look at the process in general. So once we've carried out the valuation and the client is in agreement, we need to devise a strategic marketing plan. It's strategic because each pharmacy that we come across is unique, and we need to think ahead in the context of this one's specific circumstances. We need to identify critical areas, any positives, any negatives, and we need to have a plan in place for dealing with all of that that's going to lead to the best possible outcome for the seller and avoid any unexpected issues or unnecessary exposure. There's a number of areas that we need to consider, but I'll focus on the key ones for you here today. So firstly, the pricing of the business for market. This, as we've discussed, is crucial to success, and now more so. with a larger number of pharmacy opportunities on the market. If a buyer's dismissed the opportunity purely based on its headline price, it's a very difficult position to get yourself back from. And rather than remarketing the business second time around at a reduced price, which in itself is going to appear negative, you're far better to get that starting position right the first time around. Timing of the marketing. Now, this includes avoiding holiday periods, but also whether it's a good time to sell generally. And a lot of you here today may be asking that same question now. And whilst no one's able to predict what will happen in the course of the next few years, it's difficult to see a particular reason why pharmacy values may improve in the near future. I'm sure it's going to be no surprise to any of you listening, the sector faces many challenges currently, but despite both the sizable cuts for pharmacy post-2015 and a lot of negative media attention in the time since, a strong proportion of buyers out there do remain positive about pharmacy and are taking a long-term strategic view. We are seeing some parties that are capitalising on the increase in supply and aggressively growing their portfolios, and also first-time buyers are still out in force, which is reassuring. The increase in supply that we've seen in England and also Wales, surprisingly, would suggest that prices might fall. However, in practice, they've held up extremely well. There has been some pressure on prices, I think, at the premium ends of the market, but by and large, prices achieved are still very good. For good quality pharmacies with no real issues, EBITDA multipliers are generally still reflective of premium prices. And by that, I mean they're above the 5 to 7 times formally quoted by banks and lending institutes. Is it still a seller's market though? Well, we've seen the average number of offers for most pharmacies fall from around 8 to 4 in the last few years. But all things considered, I think that's still an excellent position for a seller to be in, as it still allows for a competitive bidding process, good prices, and attractive terms of sale. On balance, I would say that there has been a slight shift in power, but it is still a seller's market and still a pretty decent time for anyone who's thinking of selling. Timeline of the sale and target completion dates. Now, this will vary depending on whether you're selling via an asset sale or a share sale, whether it's a leasehold or freehold opportunity, and perhaps also depending on the structure of your company. There'll be differing legal requirements depending on all of those circumstances. Your accountant may also advise you to target a specific date of completion for tax purposes or to benefit from certain tax reliefs. On average, we're seeing sales take about 6 to 7 months from instruction to completion. In the Patel's case, fortunately, there was no transfer of ownership required for the pharmacy license since it's a share sale. And this, as Tim mentioned earlier, saves us the troublesome exercise of dealing with NHS applications and capita alongside the sale of the business. Presentation of the business for market. We need to decide what the key selling points are. Sales particulars need to focus on any future potential and also, where possible, demonstrate the true profitability of the business. Now, this can involve including an adjusted profit and loss account in the particulars, and the purpose of that is to make very clear any adjustments which a buyer needs to consider in order to understand the true profitability on which to calculate their offer. If there are any issues or matters that need to be disclosed to potential buyers, then we need to think about the best way to present these too. Depending on the nature of the situation, that may or may not come into the sale particulars. We may in fact take a different approach and discuss matters directly with any interested parties. Confidentiality and selection of buyers. So something like about 95% of the pharmacy sales that we deal with are totally confidential. So all of our company processes are geared towards this approach. Confidentiality is naturally balanced against maximum exposure at the marketing stage. Now, our skill comes into play because we know the market and the buyers extremely well, and we're in a position to approach a select group of the top buyers from our database, those whom we know are looking for that type of pharmacy in that specific area. This, along with having all of our buyers sign confidentiality agreements before they receive any details, helps us to achieve maximum price for sellers with a measured level of market exposure that best maintains that confidentiality. The offers process. Before an offer is accepted is when the seller is theoretically at their strongest position of negotiating power with buyers. To take advantage of this, the process needs careful thought, ensuring key terms are included, such as cash balances being structured as part of the deal and buyers being made aware of any issues. Crucial information should be presented to buyers in advance to avoid issues at the legal stage. Care also needs to be taken to ensure that the interested parties understand the process ahead of them and what will be required of them. Inclusion of a non-refundable deposit within the process to protect the seller from any frivolous offers and price chips during the legal process is important. And a second round of offers generally gives us an opportunity to negotiate some higher offers alongside other favourable elements in a bid to improve the seller's position and reduce their risk. It's equally important that offers are presented in a clear and specific wording, and this helps to avoid any misunderstanding between the parties as to what the offer actually includes. This is most important with company share sales, as there is a process called the net current asset adjustment, which is applied to the goodwill price. And this is a common area of confusion for both sellers and buyers. Atif and Tim are going to touch on this point shortly. In addition to a party's willingness to pay a non-refundable deposit, we'd also want to see proof of funds before considering it seriously. And this usually consists of bank statements, company accounts, or correspondence from their accountant, broker, or bank. The important thing to consider is what the bank's valuation of the business is likely to be, since the lender will typically contribute around 80% of that offer figure, and any expected shortfall between the loan and offer amounts will need to be topped up from alternative funds. So how did we market Lucky Star Pharmacy and what were the results? When I visited the pharmacy and met with Raj, he raised a concern with me about the appearance of the shop. He said it was looking a little tired, and he asked me a question that's often raised with us, and that's whether he should refit the pharmacy prior to putting it on the market. And my advice to Raj at the time was that he'd be unlikely to see that investment return to him in any goodwill offers from buyers, since those offers are primarily based on the profitability of the business. Leaving the refit to the buyer also adds something for them to put their stamp on. So we agreed to leave it at that and push ahead. On the marketing front, Raj and Simran were happy to proceed at offers in excess of 1.4 million. And we approached a select group of 75 top buyers from our database. We marketed the pharmacy for a period of 6 weeks, and following viewings, received offers from 3 first-time buyers and 3 small to medium-sized group owners over the course of 2 rounds of offers. With that level of interest, during the second round of offers, we were able to negotiate a higher best and final position of $1,475,000 from the preferred party. And that also came with a non-refundable deposit of £30,000 for Raj and Simran. That's £10,000 more than our minimum level. And that just gave the Patels an added sense of security and confidence. The successful offer was from Smith & Sons Pharmacy Group, an independent operator with 6 branches that border North London from the east. Raj and Simran felt that Smith & Sons had a similar ethos to them, they'd be a good fit for the business, and that they would take good care of the customers that they've built up over the years. Comprehensive heads of terms for the deal were then drafted, and these were circulated between the parties and their advisors. We also worked to secure the holding deposit as quickly as possible from the buyer so that we could get the legal work well underway. At this point, Atif and Tim start to get more heavily involved again, and Atif's going to take over the reins for us now as the legal process starts to kick off.
Thanks, Scott. Now let's talk about what happens once you've found a buyer. The next step is the due diligence process that Tim mentioned earlier. Once Smith & Sons had paid their deposit, they started the due diligence process and their accountants requested a list of information. As this was a share sale, they wanted to go back over several years so they could be as comfortable as possible about the history of the company. As we had now been working with Raj, Simran and Lucky Star Pharmacy for the last 2 years, we'd improved the quality of the record keeping and bookkeeping system for the company, so we could easily get everything to the buyer's accountants in a clear and consistent format. They could then go through the information provided and satisfy themselves that everything was in order and there were no hidden skeletons in the closet with a minimum of effort. While Smith & Sons accountants were going through the due diligence information, their solicitors produced a draft share purchase agreement. This was sent to both Tim and us to review, and here's Tim to tell us more about it.
Thanks, Atif. So the key document legally within the sale process, as one might expect, is the sale agreement or the contract of sale for the shares. And just to give a brief flavour of some of the more key areas that would cover, first and most obviously, of course, price. As Scott has mentioned, following a successful marketing campaign, the headline price for the shares, namely for the goodwill and fixed assets of the business, was agreed at £1.475 million. Also, as Scott has mentioned, that is then usually subject to an adjustment for what is called net asset value. And net asset value is then verified by a set of completion accounts for the business that are generally put together and agreed over a period of 3 to 4 months following completion of the sale. The net asset value, put most simply, is the value of the current assets of the company on the day of completion, less the extent of its liabilities. So the value of its stock, verified by a stock valuation, plus its cash at the bank, plus its debtors and prepayments, less its creditors, liabilities, accruals, and a provision for tax. This will either then generate a net figure that is positive, and that sum is paid in addition to the headline price, or if it's negative, for example, if there are sizable borrowings within the business, it's deducted from the headline price. Another key area, and one in which most vendors will be more heavily involved in terms of settling drafting, are warranties. Warranties are essentially statements about the company, its business, its financial affairs that are included in a schedule attached to the contract and are given at the point of completion. They'll cover a wide range of issues, including ownership of the assets of the business, whether the business has complied with relevant laws and pharmaceutical requirements, whether the business is in dispute with anyone, is there any litigation, has the business got all the required insurances, and generally there would normally be some accounts and tax related warranties given as well. These warranty statements are then accompanied by something called a disclosure letter, which is essentially a letter from the sellers to the buyer that accompanies the sale contract and is signed at completion, within which the sellers can disclose anything that might be of relevance against the warranties. So, for example, if there is a warranty that the company is not involved in any current insurance claims at completion, and there might be an insurance claim at hand, perhaps a motor insurance claim or something of that nature, this is where the sellers would then provide information about that to ensure that the buyer is aware of it and can't complain that it wasn't provided with relevant information. A share sale agreement will also typically include something called a tax covenant, which is entirely standard, and essentially this says that to the extent that there is tax liability within the company that relates to any period down to the point of completing the sale, and which at completion has yet to be paid, and which isn't taken into account in the process of settling the completion accounts, then that would be the payment responsibility of the sellers, should that tax liability come to be collected by HMRC after completion. And because the sellers are therefore entering into a number of warranty and tax commitments within the sale agreement, there would typically be included within the contract some provisions which exclude or limit the extent of the seller's liability, to provide a little peace of mind that if something slips between the net in terms of perhaps a warranty claim, then there is a saving provision for them. And there are a number of these types of provision. The key ones from a vendor perspective would be having a time limit after which they cease to be responsible for claims, and also having some financial limits. So there would normally be a ceiling on the maximum liability that sellers might have, but also normally a requirement that if the buyer does have a claim, that claim must have a minimum value. It's a form of defining what is a material loss that the buyer can come and trouble the sellers for. It's a bit like a form of insurance excess, if you like. But those are important considerations that will normally be negotiated. And a final word on restrictive covenants, which are an important part of the sale contract. And essentially, as is the case with Mr. and Mrs. Patel, a large part of the pharmacy's goodwill is its relationships. And those relationships are most commonly wrapped up in the personalities within the business, the vendors. And at the point of vendor retirement, they realise the value for goodwill, in this case, nearly £1.5 million. And understandably, the purchaser won't want to find that 6 months after completing the purchase, Mr. Patel's decided to maybe open another pharmacy a little way down the road, having got bored of his retirement, or perhaps has gone in with a friend that he knows who's got another local pharmacy. The danger, of course, being that patients might then migrate towards that other pharmacy and away from the business. So it is very common to find that there are some restrictions included within the sale agreement for an agreed period, normally a maximum of 2 or 3 years, not to have that type of competitive involvement in a nearby pharmacy. And it is normally defined by way of a geographic radius in terms of the restriction. Most commonly, we tend to see that that's something like 1 mile or 2 from the pharmacy that's been sold. So that's a quick flavour of some of the key components of the sale agreement. And the important thing is that one ensures that all those various aspects are covered off properly for you within the documentation, so that sellers have the peace of mind of knowing that at the point of completion, their interests have been sufficiently protected and they can rest easy that there won't be any claims for money back after they've completed the purchase. So I'll pass you back to Atif to take the story on a little further.
Fantastic. Thank you, Tim. As accountants, our job is to work alongside Tim and his team to go through the share purchase agreement with a fine-tooth comb. We need to check exactly what Raj and Simran would be agreeing to by signing it, suggest any changes to the main terms and covenants where we thought the conditions were unfair on them, and to carefully go through the warranties to make sure the buyers are made aware of any exceptional events or circumstances. Because pharmacy is all we deal with and we see plenty of sale agreements in the course of our work, between our two firms, we know what is appropriate and what is excessive to warrant. And so, with our combined experience, we were able to limit the Patel's risk. The sale agreement sets out how the seller is to be paid for the net assets of the business, in addition to the payment for goodwill. Once the target date for completion has been agreed, we need to provide the buyer side with a figure for the company's estimated net asset position at that date. This is made up of the company's assets, things it owns or is owed, like cash, stock, and debtors, minus the liabilities, or things it owes out, like money owed to suppliers or HMRC, but excluding fixed assets like equipment or shop fittings. Of course, we're not able to provide exact figures at this point because we'd need to wait to get statements from the NHS and suppliers, which wouldn't be available till sometime after completion, so we estimate this as best we can. This estimate then gives the buyer an idea of the net current asset payment they will need to make in addition to the payment for the goodwill and fixed assets. And once the completion accounts have been prepared and agreed by both parties several months down the line after completion, a final payment can be made for the actual amount due as per the accounts. When we reviewed the sale agreement, there were a number of things that we picked up. For example, we felt the proposed method to calculate the net current asset figure was unfair, as it included deferred tax as a liability to the company, and this reduced the additional payment due to the Patels. We went back to the buyer's solicitors on this point and asked them to change it. They were reluctant at first, as they said it was standard practice, but we were able to explain our rationale for excluding it, and eventually we got their agreement, which meant the Patels were £14,000 better off. The agreement also set out the terms by which the business would produce the completion accounts and what the procedure would be if the accounts were not agreed by the buyer. The time frame for us to produce the accounts stipulated by the buyer was quite tight, as they wanted us to send them within 3 months. We knew this was likely to be problematic, as we wouldn't be able to complete work on the accounts until we'd received all the relevant information, including the NHS FP34 statements, which wouldn't be available until at least 60 days after the completion date. So we asked for the period to be extended to 4 months, which was agreed by the buyers and ensured the Patels would not be in breach of this point. We also went through the tax warranties in the agreement very carefully and cross-checked them with the company's accounts for the last 3 years to produce a list of any facts and circumstances that needed to be disclosed. And these were then collated by Tim in the disclosure letter. The tax warranties are very detailed and refer to numerous statutes from tax and company law, so it's essential they're looked at by an experienced accountant familiar with your business and pharmacy sales. Putting the time in to get this exercise right meant the Patels could sign the agreement with peace of mind and confidence that their interests were protected. Right, now I'll just hand over to Tim to tell us a bit more about some of the issues that came up on his side.
Thanks, Atif. So there were a few points of interest that I thought it would be useful to mention and walk through. The first 2 points are linked. So you may recall that the Lucky Star Pharmacy lease was one which Mr. and Mrs. Patel had been asked to give their landlord a personal guarantee for. And there was obviously a concern that the sale of the company doesn't terminate that guarantee and would mean that they would continue to be guaranteeing the company paying the rent and complying with the lease terms, despite the fact that they no longer own it. This was linked by another complication in the sense that under the lease, the rent was to be reviewed every 5 years. And the rent review dates, as is usual, were set out in the lease. And the landlord had yet to invoke the rent review that had actually fallen due about 8 months prior to the point at which we were looking to complete the sale. So we needed to decide how best to deal with this. Ordinarily, one would approach the landlord if one has given a personal guarantee on the lease and look to try and negotiate a release of that guarantee and perhaps have the purchaser stand in place and offer their personal guarantee. That was a difficulty in tactical terms in this case, because it was felt that if we did that, with the outstanding rent review sitting there, it might give the landlord an idea of taking a more aggressive approach in settling the rent review, in the knowledge that Mr. and Mrs. Patel needed to sell and were keen to be released from their guarantee. So we took a tactical decision with Mr. and Mrs. Patel not to raise the issue with the landlord prior to completion, indeed not to involve the landlord in the process at all. So the solution in this case was that we agreed that the purchaser would approach the landlord after having completed the sale with a view to seeking a release of the personal guarantee and offering itself in replacement, coupled with the purchaser's commitment to compensate pound for pound Mr. and Mrs. Patel in the unlikely event that between the time of completion and getting that personal guarantee released, if there was, for example, a default in the rent payment or some other claim under the personal guarantee from the landlord, that the purchaser would meet that and ensure that Mr. and Mrs. Patel were not left out of pocket. And similarly, in relation to the rent review, it was agreed that the purchaser wouldn't offer to invoke it, but that if the landlord did invoke that rent review after completion, the purchaser, whilst they would obviously have conduct of that discussion as the new owner of the company, would involve Mr. and Mrs. Patel, keep them informed and give them a role in any dialogue looking to settle any increase in rent applying from that review. And of course, both parties had an interest in ensuring that that rent review came up with the lowest possible increase, because as one would expect, with the rent review date having kicked in prior to completion, any increase in rent that would have been settled would mean that Mr. and Mrs. Patel would be responsible for their proportion of it for the period from the rent review date down to the point that they completed the sale, and of course the purchaser thereafter. We had a dialogue with the purchaser's solicitors in relation to Nhs Clawback Liability, which is something that most pharmacies will be familiar with now. In particular, Category M clawback charges. And fairly late in the process, we had a request from the purchaser's accountants to include a provision within the contract that allowed the purchaser to seek to recover part of the purchase price in the event that after completion, NHS England announced a clawback liability that related to any period prior to completion. And you'll know that the way that Category M clawback charges, for example, works is that the clawback is announced and is framed by reference to a perceived generosity in historic payment rates, but that it is actioned by adjusting the drug tariff rate at which those items are then reimbursed going forwards. So it is a historically framed charge that impacts on a pharmacy's future revenue. And we were able to push back against this on the basis that clawback charges have been around for several years. The application of those charges on an annualized basis was something already reflected in the annual accounts, and most notably in the accounts on which the purchaser had made its offer. The impact of those charges had already been reflected into the EBITDA that Scott mentioned, and therefore it wouldn't be appropriate to make a further adjustment to reflect that again. There was also the point that in the same way as rent, utility costs, rates, and other charges can fluctuate over time as overhead costs of the business, Category M clawback and other equivalent charges ought really to be characterised more in that nature. And of course, it's also the case that drug tariff rates of reimbursement for a large number of drug items can fluctuate for all manner of reasons, and they can go up as well as down. And so for all of those reasons, we were able to deflect that particular line of argument. We also had a discussion around the fact that there was quite a bit of surplus cash held in the company at the point of completion. Mr. and Mrs. Patel, in the run-up to the sale, decided not to continue to extract dividends and market rates of salary, but instead to leave the cash within the company and extract it as part of the share price for tax purposes. So at the point of completion, we actually had around £120,000 worth of surplus cash within the company to include within the net asset value calculation. And the buyer's accountant made a request that rather than the purchaser have to pay cash for cash at that level, they preferred that Mr. and Mrs. Patel withdrew that cash as a dividend prior to completion. The issue there was that in taking it as a dividend as high rate taxpayers, it would have meant Mr. and Mrs. Patel paying around £55,000 of tax for the privilege of extracting that money. We were able to come up with a workaround there and essentially agreed that the money would be left in the company and included within the net asset value, but that the equivalent payment for that cash could be made a number of days after completion, which meant that there was no cash flow cost to the buyer in making that payment, as in a sense the payment was self-funded by the money available to the purchaser within the company that it has just acquired. There was a small tax charge for the purchaser in the form of stamp duty, but the tax rate for stamp duty is 0.5% and substantially less than income tax charges. So as the quid pro quo, we were able to offer to cover that cost for the purchaser, which meant a tax charge of £600 rather than £55,000. So a successful outcome on that point. And then finally, just to complete the story I was telling earlier, in the context of the investment property. So Mr. and Mrs. Patel opted to go with the third option that you may remember I mentioned earlier, where they purchased the property at market value for £220,000 a month or so prior to completing the sale. That payment was left outstanding as a loan, which meant that at completion, within the balance sheet, there was a director loan account balance owing to the company, and therefore a current asset, of £220,000. And we had a discussion with the purchaser and their advisors as to the best way to deal with that. And we were able to agree, as is the usual process for this type of adjustment, that that loan balance would be repaid by Mr. and Mrs. Patel from their sale proceeds on the day of completion by directing £220,000 straight back to the company's bank account, with that figure to then be treated in the same way as surplus cash, and the point that I've just mentioned above, such that that equivalent payment then came back to Mr. and Mrs. Patel a few days later and left them with a neutral effect on their overall sale proceeds. There was some stamp tax for the buyer of about £1,000 there, but again, a successful outcome and completing the process of the property extraction. I'll now pass you back to Atif.
Lovely, thank you, Tim. Now that brings us up to the point of completion. When the buyers were happy with the results of the due diligence exercise and the sale agreement was close to being agreed by both parties, the completion date of 31st of July was confirmed for ownership of the property to transfer from the Patels to Smith & Sons. It's generally helpful if completion dates can be at a month end, as this makes it much easier to calculate the position at the point where the business is transferred. Once both parties had agreed the wording of the sale agreement, we were all set for completion. On the day, the agreement was signed, the shares transferred, payment was made to the Patels, and the pharmacy officially changed hands. Now, from this point on, the next thing we need to consider is the completion accounts. If we were to fast forward 2 months from completion, the Patels have been settling into retirement and we'd received the NHS dispensing statement for the month of completion. And with this, we could finalise the accounts. These need to be prepared with extra care and attention to detail to make sure they represent the closing position as accurately as possible, so you can benefit from all the profits from your period of ownership of the business without paying for any of the business expenses from after this date. Once we'd prepared the accounts on this basis, they were sent to Smith & Sons accountants, and under the terms of the sale agreement, they had 20 days to make any inquiries or accept the accounts. After reviewing the accounts, Smith & Sons accountants sent us a list of payments made by the company after completion that they believed were incurred before that point and so should be included in the accounts. We went through these with Mr. Patel and eventually agreed that 2 of the invoices were related to his period of ownership and so should be included. We revised the accounts accordingly, and these were then sent to the other side and finally accepted by both parties. Smith & Sons then released the final balancing payment for the net current assets, which meant the Patels had now received full payment for their business. The final step is declaring the sale on your personal tax return and calculating and paying the tax due. Now, the sale had completed on the 31st of July 2018, which meant it fell in the tax year ending 5th of April 2019, and so would need to be reported in the Patel's 2019 tax returns. These need to be submitted and the tax paid by the 31st of January 2020. The Patels had received a total of 1.8 million for their business as its assets and paid professional fees of 70k. So their total gain from the sale were £1,730,000, and the capital gains tax due on this after the application of their annual allowance and entrepreneurs relief was just over £170,000. This is hundreds of thousands of pounds less than they would have had to pay if they'd structured the sale as an asset sale or extracted the surplus cash before the sale or failed to qualify for ER on all of the proceeds. Once we calculated the tax bill, we were able to advise the Patels on ways that they could reduce it. Another important area they needed to look at was estate planning. Now, the Patels had already written their wills with Paul's help, but they needed updating. Fortunately, Charles Russell Speechleys were on hand to assist with their will writing service. We also advised the Patels on their exposure to inheritance tax. When they owned the business, they could benefit from business property relief, which meant if they were to die, the business assets would be outside of the scope of inheritance tax. But once the business is sold, business property relief no longer applies, and their share of the cash proceeds would be liable to inheritance tax if either of the Patels were to pass away. Again, working with Paul, we could present options to mitigate this risk. We'll also be hearing from Paul on how he advised them on investments they could make for an income in retirement. And apart from that, they just needed to decide what to spend the rest of their money on. At the end of the day, the Patels were overjoyed that they'd managed to sell their business quickly and with a minimum of stress, while receiving a higher price and paying less tax than they'd expected. And now over to Paul with more details of his advice to them.
Thank you, Atif. So 25 years later from when I first met Raj and Simran, they've now built up a successful business and sold it. So as you can see, they had cash from the sale of a business of around 1.6 million. Pensions, with my advice, of £1,030,000 each. I'll come back to that in a second. ISAs worth £300,000 each. Not only did they have the buy-to-let property within the business, they also managed to buy several others outside in their own name. They also had some cash in the bank, and the main residence was worth £1 million. So this was only achievable with ongoing financial advice, where we made the use of all the allowances and tax rates and regimes. So just going to touch on pensions very quickly. So pensions now are extremely flexible. So if you haven't got one, I'd advise you to seriously consider what you need to do. So if you remember, I said to Raj and Simran to start paying £50 a month. So 25 years ago, that was all they could afford. And we got the company to pay that, a limited company, and that benefited from corporation tax relief. As their profits increased and they had drawn their salary and dividends, they still had excess cash and profits in the business. So we took them up to their maximum amount, which was £40,000 each, and paid that into their pension for a number of years. So that £40,000 each saved them just under £8,000 of corporation tax relief. So an extremely tax efficient way of extracting money out of the business for their own benefit. Now that pension fund of £1,030,000 can provide them with 25% tax-free cash, or just over £250,000, and the remaining pot of money is used to provide them with an income, and they can decide how much they want to take out, from zero to all of it in one go if they want to. But probably the most useful thing now is that pension money sits outside of their estate for inheritance tax purposes. So potentially, if they don't need to draw an income, we see pension money now as a family trust, and that's very interesting for them because they want to be able to leave a legacy to their children and grandchildren. ISAs, they've got £300,000 each, and again, we started off £50 a month, £100 a month, £200, and the current limit today is £20,000 each. The buy-to-let properties are in joint names as well. So what I often find with most clients is they have very small pension pots because they believe that pensions are inflexible. They hardly have any money in ISAs, and most of the clients I come across, because they haven't had financial advice, all their savings are in cash in the bank, which is probably the worst place for it to be because inflation has just eroded the true value of that money. So these are the assets they've built up. And then the next problem is, do they have too many assets and too much money? And then how do they structure the income in the most tax efficient way for their retirement? Obviously, Atif mentioned inheritance tax. They've currently got a tax liability of over £1 million. So what do we do with that? what are the rules, and that's where it leads on to estate planning and wealth preservation. Do they gift the money? Do they spend the money? What do they do with it? So lots and lots of things to consider with inheritance tax and estate planning. And probably very importantly at this precise moment is to make sure their wills and powers of attorney are enforced, to make sure that their estate goes to who they want it to, and powers of attorney, especially because of their wealth, to make sure that somebody can control their finances or be able to act on their behalf should they be incapable of doing so. So the money they've received, they wanted the most tax efficient income possible with the money. So we haven't considered inheritance tax at this precise moment, but what can we do? So with their ISAs, all the income is tax free. So we use 4% as the rule of thumb, and they had £300,000 each. So both Raj and Simran can receive £12,000 of tax-free income. Again, their buy-to-let property generated £12,000 of income each. That is taxable. If they decided to draw an income from their pension, that's just over £30,000 each. Again, that is taxable. And if they invested their sale from their pharmacy, then again, we have capital gains allowances to use each year. We have dividend allowances to use each year. And we've also got a product called an investment bond, where the income is tax deferred. So using all the available allowances out there, they could receive a total income each of over £108,000, of a taxable income of £31,000 each. So they would potentially only pay £6,000 each of income tax to the taxman whilst receiving an income of over £108,000. So it's very important that you structure their savings or your savings in the correct manner to make sure that both parties have an equal share of the wealth, because later on it's extremely useful to make sure you can use all your tax allowances. What we wouldn't and didn't want to do is just make sure, for example, Raj had all the money in his name, because that would just create a very high tax charge on his name with Simran with no income at all. So always make sure you split the wealth between you equally so that we can make use of all the tax allowances. So Raj and Simran didn't actually take all this income, but I just wanted to demonstrate potentially by using all the allowances over the years and receiving good financial advice, how to build up your funds slowly at the start and then increase profits, increase over the years to paying the maximum allowable. So in this example, Raj and Simran are delighted with the income they can receive, and they're just currently working out what they do want to receive. And obviously the most important thing is how they are going to leave that wealth to their family and avoid paying as much inheritance tax as possible. So it's quite a complex scenario and situation they're in, and that's why good financial advice from start to finish is essential to make sure they are always on track to meet their goals. That's the end of my session. We're just going to move on to a few questions which we've had in before we finish up.
Thank you everyone for your questions tonight. I'm just going to pick a few to cover now. One here, I have sold some old pensions from previous employers. What can I do with these?
Okay, so the most important thing with any old pensions you have, or even any current pensions, is to make sure they have the new pension rules attaching to them. If they're not the new pension rules, then what you want to make sure is you have a full review of those, which is what we can do for you at DGS, just to understand what you've got and whether they can be transferred into a new plan or existing plan, to make sure that they can, as I said before, continue to be passed down to the family members if you want, and also draw benefits from them. So we'll provide a review of your old pensions and be able to tell you what you can and can't do with those.
Thanks, Paul. Another question I've got here. I don't remember having switched the license from personal name to my company when I incorporated. What is the process for getting this moved over now? Are there any consequences for this oversight?
That sounds like one for me. It's Tim. So I think they're probably talking about the pharmacy license, and as I've mentioned, it's important to make sure the license is in the right name, so they're asking the right question. This is actually quite a common thing that we see, and I mentioned earlier in my talk, quite often what happens is that pharmacies are set up by sole traders, they then move across to company status, and they forget to let the NHS know. And at the point you're trying to sell the company, you don't want to find that the NHS license is still in the director's name, because that's obviously a key part of the business, and the purchaser will always want to see the NHS license in the company name. So the advice is definitely get it sorted out. It will generally require an application to be made to NHS England or the local health board in Wales to have the name transferred. If you're very lucky, and you can chat up your local area team contact, they might do it without treating it as an arm's length transfer application, but quite commonly they will say you've got to go through the process of providing the fitness to practice information, and they've got to go through their formal consultation process with local contractors. So it may take 2 or 3 months to get the matter rectified, which I guess is a case in point for plan ahead, check these things early.
Can I just add to that as well, Tim? So this is Scott here. You can check if you're unsure what name the license is currently in. You can check it by looking in the top left-hand corner of those FP34 statements. It should, if you're trading as a company, it should clearly state there the company name, trading as the pharmacy name. It's not always entirely accurate, but if you're not certain, it's a good place to look for some reassurance. If you do have to go through the process, obviously for our clients we can assist with that. We are used to doing those applications, and we can give you some guidance around that as well.
Another point, so it's Tim again, that's sort of linked to that is the GPHC premises register, which I also mentioned worth checking. Again, It's exactly the same issue there. If you go online to the GPHC website, put your postcode in, it will pop that up for you and confirm the name. By and large, you'll find that whatever name is on the NHS contract should be the same as the name on the GPHC premises register as a guide. Don't always assume it, because it's not unheard of that the GPHC and NHS England haven't spoken to each other. Yeah. But generally speaking, that's also a good indication. If you find it's wrong there, there's a good chance it might be wrong with NHS England as well.
Great, thank you. Another question. We anticipate having a high level of cash in the business at the point of sale. When would we get paid for this?
Hi everybody, Artif here. I think Tim did actually pick up on this point in a bit earlier, but I think the really key thing here is good communication. It's really important that you communicate with your advisors, with the buyer, with the buyer's advisors, so that everybody's on the same page. And as long as that's done, at the point where the sale agreement is being negotiated, it can then be agreed. If there is a high level of cash in the business, it can be fixed in the structure of the sale, and effectively you can get paid for that or most of it at completion. It's just as long as everybody's on the same page and everybody agrees.
I suppose the only thing to add there is just be careful with how much. Generally speaking, you don't tend to find that the surplus cash is more than 20%, say, of the overall goodwill value of the business. But I did have one occasion a few years ago where it was, and you've just got to be a bit careful. Artif mentioned earlier that there's tests for qualifying for entrepreneurs relief on your sale proceeds. What you don't want to find is the revenue saying you got so much cash that you can't be a trading business, you must be some sort of investment business. There's normally ways to deflect that argument, but I agree completely with Artif. Have an open dialogue and raise it early. These things can always be checked, and there's usually a way through.
Absolutely.
From the marketing perspective, and whether it would affect your finding a buyer, I think it comes down to how it's put across to them and what the nature of the situation is, size of the business, what kind of buyer you're looking at. Obviously, a first-time buyer will be far less experienced with that kind of thing than someone who's been through the process a couple of times. So I think it just comes down to presenting it to them in a clear way so that they can understand that there are workarounds and ways that can be done tax efficiently.
Great, and I think we'll just do one more. My health centre pharmacy lease is not under the Landlord Tenant Act. I have 9 years left on the lease. Is this okay? I don't want the landlord to know I am going to sell my pharmacy.
Okay. Yes, this is Tim. This is quite a common one. I think first point is just to explain what is meant by whether a lease is under the Landlord and Tenant Act. And again, you may remember earlier in my talk, I mentioned that if you're going to have an early review of the lease, which is something we do a lot for clients just to make sure it's going to pass muster, it's a question of, is it renewable? And that's what this, is it under the Landlord and Tenant Act means. And generally speaking, if you're a business and you're occupying premises under a lease, you'll find that if the lease was granted for an initial period of more than 10 or 12 years, then you will have a renewable lease, in the sense that the landlord and tenant legislation says that, subject to a few caveats, when your lease expires, you can generally renew it on broadly the same terms. But there is a provision, a mechanism within the law that allows the landlord and tenant, when they're granting the lease, to exclude that right of renewal. And we do see that from time to time. It's pretty unusual for the right of renewal to be excluded when you're signing up to a 15-year lease, say. But health centre pharmacy leases are a bit of a rule unto themselves. And quite often you'll find that, particularly if the health centre has been developed under the local finance scheme, as part of the government funding arrangement, you may find that the lease was granted without a right of renewal. If you've only got 9 years on your lease and it's not renewable, you may have a problem in terms of sale, depending on who you sell to.
Yeah, I think again it depends on the buyer that you're looking at and what their take on the situation is, whether they're bank funded, that kind of thing.
Yeah, I mean, the banks generally tend to want to see at least 10 years on a lease. If it's a bit less than 10 years and it's renewable, they'll normally take a view. But
if they like you as a buyer, they might be more flexible.
Yeah, quite. And if you've got other businesses with them and they've got other security, it might be okay. But I think certainly you're right to flag it, and it's something that's worth just giving some thought to. And it may guide the marketing process and dialogue in particular around it.
Okay. Good. So right, I think we'll call it a night there. As Kate did mention, and I think we did earlier as well, we have had a lot of questions. We will come back to all of you on those during the course of tomorrow. So just enough time to say thank you again, all of the panelists.
Thank you very much.
Thank you, and good night.
Thank you everyone for listening.